Hey everybody, Tyson Stracks here on Monday, October the 2nd. Can't believe it's October. Fall is here. You can kind of feel that in the air. Um, and next week, Tuesday, is opening night, regular season, which seems crazy. Again, I'm always thinking of these guys going through camp. Hope that the bodies are hanging in there. Um, I saw one kind of cool story come out of that Craft Hockeyville up in Sydney, Nova Scotia. There this year, that's where Cape Breton in the Q plays out of, and so Drake Batherson, obviously of the Senators, played his junior, well, 3 years of his junior there. They beat the Panthers in that Hockeyville game 4-2. He's got a goal and 3 assists. Pretty fun to see him go back to where he played junior and have such a big game. Topic here. I'm gonna try to keep this somewhat simple, but talking about the bond market, fixed income. A lot of people, and we're obviously in review season. This is a topic that we are covering with a good amount of our clients. But it's very interesting to see how fixed income is setting up right now. Halyard came out and said that fixed income right now is the most attractive that it's been since 2009. And, this is something that there's actual objective measurements for. And I'm not going to go into, again, all of the details of this. But just to differentiate here and some reasons for this. So stocks and bonds, differences to that. Stocks can live forever, really, into perpetuity, where bonds have a maturity date. Bond prices and rates have an inverse relationship, right? So as we have seen over the last couple of years, the fixed income market, which typically we refer to as the safe part of people's portfolio, right? Fixed income has been a terrible. 2022 was the worst year in history for the bond market, just to put that out there. But this is obvious because as rates have been going up, as the Fed is raising rates, bond prices are going down, right? But as we mentioned, bonds have that maturity date. So as bonds get closer to that maturity date, they have to get back to their par value. So if you just think of a bond, say priced at 100, we just use that as a good example. As rates go up, that bond price keeps going down. Say now it's trading at 80. Now it's 3 years from maturity. Over the next 3 years, that bond has to start coming back up to 100. By the time it reaches maturity date, it has to be at par value. So we're just going to see a tailwind here as bonds. And again, here we're not talking about junk bonds. We're talking about, investment grade, in this example, investment grade corporates, because I'm going to talk about another objective measurement, and this is called the yield to worst. So this is a calculation that shows basically, when you look at bonds and the different types of bonds, right now they have a yield to worst. You can do this calculation, and that calculation basically shows you the worst case scenario for a bond. The yields to worst, if you're looking back over the past 10 years in this realm of investment grade corporates, somewhere averaging sub 2%. Right now, that's closer to 6%, the yield to worst. And then we also have the scenario again. So as they get to maturity, they have to get back to that par value. But if we also have a situation where in that 3-year period, the Fed starts to lower prices, not only will that bond come back up to par value, but it has the possibility and the eventuality of actually increasing in value. So in this sector where we see a yield to worst of 6%, it's not crazy to think that we could see 6, 7, 8%, you know, on those investment grade corporates in this scenario. So I said I wasn't going to get too geeky. I definitely left a lot out there, the minutia of it, but definitely a very interesting scenario that's developing in fixed income. And obviously we have seen 2 years of really bad bond markets. Last year, the worst we've ever seen. So probably a lot of people right now thinking, why would I be in fixed income? Well, fixed income is actually looking quite attractive right now. And speaking on that, on rates, etc., that yield curve that we talked about last week, the inversion, starting to come back, right? The spread right now between the 2 and 30 is now at negative 35 basis points, where last week's video we talked about just over 6 months ago it being 117 basis points. So now we're at minus 35 basis points. So we're starting to see that continue to come back, that disinversion. And then last week, economically, we saw PCE, which is obviously the Fed's preferred inflation data. That number came out lower than expected, which is a good sign, a little boost there. And then this week going forward, everybody's going to be keeping their eye on Friday, because the September jobs report will be released on Friday morning. So we are having a great time in all these client reviews. We look forward to continuing to catch up with those of you that we have not yet, and hope everybody has a great week.